Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening for our webinar on some diverse investments for self-directed retirement accounts. Before I get started, I do want to give you just a bit of information about STC. We are a retirement plan administrator only, so we do not provide any legal, tax, or investment advice. We also don't represent or sell any particular securities or investments. We're not a registered investment advisor, and we don't represent or endorse any particular investment opportunities, and I will be talking about some different ones during this presentation. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. In this evening's webinar, we are going to talk a little bit about what a self-directed retirement account is, and then we're going to cover some different types of investments that you might want to consider: short sales, foreclosures, partnering with 1031 exchange property, tax liens, precious metals, investing in privately held businesses, and then I'll give you some details about STC services, and we will open the floor for your questions. So to get started, I do want to give a definition of what a self-directed retirement account is. It means that you are holding your account with a company that allows you to choose any type of asset that is permitted by law. Some companies will only hold certain types of assets, stocks, bonds, mutual funds, etc. But a company, if it's truly a self-directed company, they will permit you to hold anything that is allowed by law. And that would include what some consider non-traditional assets like real estate. With a self-directed account, you also manage your retirement plan's investments. So if you should choose to purchase a piece of real estate in your retirement account, you will be the one that will make the decisions related to that property. If you're going to rent it, what the rental rate will be. If you're going to renovate it, you will be the one to hire a contractor, choose new furniture, those types of things. You'll make the decisions related to your investments. So basically, you have direct control over the investments that you're holding in your retirement account. Some of the biggest benefits of self-direction include true diversification. You can include those non-traditional types of assets like real estate, mortgages and notes, private businesses. So you can really diversify your retirement portfolio over different types of assets that don't necessarily move in sync with one another in the marketplace. You will choose, you'll control those investments, and if you are interested in real estate, you can increase the buying power of the dollars in your retirement account through the use of leverage. Because of all of these things, you may be able to experience a higher return on your retirement investments. There are a number of different types of retirement plans. A self-directed plan simply means that you are holding your plan with a company that permits self-direction. It's not a type of plan. So these types of plans that I'm going to list can be self-directed, a traditional IRA, and a Roth IRA. These are probably common to you. The thing that they have in common is that their annual contribution limits are identical. For 2022, those amounts did not change. You can contribute $6,000 of your earned income into one of these accounts. If you are 50 years or older, you can add another $1,000, making that a total of $7,000. The distinction between these two accounts is that when you make a contribution to a traditional IRA, like most retirement contributions, it is made pre-tax. In other words, you're not going to be taxed on that contribution. You will be taxed when you begin taking qualified distributions out of that account. Roth IRA contributions are different. When you make those contributions, they are post-tax, meaning you are going to include those dollars in your taxable income in the year that you make that contribution. However, as those monies grow through the years and when you reach retirement age and begin taking qualified distributions from a Roth account, those distributions are not included in your taxable income. So that's a very big difference between a traditional and a Roth IRA. A SEP is a simplified employee pension plan. It is sometimes used by small business owners with not a lot of employees. You can have an employee and an employer contribution. Can also be used by a sole proprietor who is both employee and employer. The advantage of this plan is it has a significantly higher contribution allowance. You'd actually be making contributions from the earnings of the business that the plan is on. And for 2022, that maximum contribution increased to $61,000. So you can see that's a considerable difference between the contributions from earned income to traditional Roth IRAs. A simple plan is a savings incentive match plan. I've seen these used by sole proprietors, some partnerships. I've seen use this type of a plan. It also had an increase in its annual maximum contribution in 2022 to $14,000. So that increased $500. I'm bringing out onto your slide now 4 different plans that all say former employer. A 401k is a for-profit corporate type of plan. 403bs are often used by nonprofits or charitable organizations. TSAs, tax-sheltered annuities, and TSP, thrift savings plans. If you formerly worked for an employer and you participated in one of these types of plans, then you can move the money out of that plan into a plan that you qualify for, say a traditional IRA, or if you have a business, a SEP plan. You can move those monies out and then you can self-direct them. Now, if you are currently employed and you're participating in one of these types of plans, then you would need to go to your employer and your plan administrator and find out if you are eligible under the plan documents to roll over monies out of that account into a plan that you qualify for. So you would need to go to your plan administrator if you are currently employed. Now, I brought up next on your slide Solo 401k. This is a plan that it's been out for some time now, but it is a newer plan, and it was developed in order to give sole proprietors, individuals who are basically in business by themselves, the same kind of opportunity as 401k plans. So with a solo 401k plan, a sole proprietor, it really very, very limited employees, really only part-time, very limited, or a spouse can be working in the business that the plan is on. But it does permit you to make both an employer and an employee contribution. You can also have a Roth provision in the solo 401k plan so that some of the contributions into the plan are Roth contributions that will not be included in your income when you take qualified distributions. Another nice feature of the solo 401k plan is that there is a loan provision that you can write into the plan documents. And I mean, oftentimes small business owners or sole proprietors need funds for whatever, and you can take a loan from the solo 401k plan. It can be used for any purpose. It does not have to be for the business, as long as that is paid back in a timely manner and with the interest according to the terms of the document, then those funds can be used for any purpose. So that is a nice advantage of a solo 401k plan. If you have a Roth IRA and you set up a solo 401k plan that has a Roth provision, you actually can contribute to both of them. You can contribute to the Roth solo 401k portion and to the Roth IRA. So that is a nice advantage as well. If you would like more information about a solo 401k, please do get in touch with me. My contact information will be at the end of the webinar. Now, I want to talk about some of these different kinds of investments that you might want to consider depending on your level of expertise, or if you know people who have expertise in these areas. Now, I did a joint webinar with Barbara Clappett of Renaissance Enterprises. She specializes in short sales and foreclosures. You can see the details of that and listen to that webinar on our website. on our internet website, and I'll give you that information at the end as well. But I'll just give you some overview, general information from Barbara regarding short sales. So first off, what is a short sale? It is a sale of real estate where the lender agrees to accept less than what is owed in order to release the lien against the property that secures that loan. So it could be first lien on a home mortgage, it could be a home equity line of credit, and it could be a lien for a second mortgage. Now, there are a couple of ways you could participate in a short sale opportunity. One is you could actually be the bank and make a loan to an individual who is doing the short sale. So in that instance, you wouldn't actually be you wouldn't own the property, you would actually own a loan in your retirement account, and you would set the terms of the loan with the borrower. The other opportunity with a short sale is for you to actually have your retirement account own the property. So Barbara's suggested short sale criteria, which she can cover in detail with you if you're interested in getting in touch with her, are number one, the owner cannot make the payments on the property, on the loan, and the owner has no other assets that can satisfy that debt. The property value is less than the loan balance, and your offer, your investor's offer, is going to be equal to or greater than an auction would provide. So you will be needing to do some research to determine if a property would meet those criteria. Now, to locate short sale properties, you can go to the MLS listings. You can also look in the newspaper for foreclosure listings, and you can go to the courthouse in the jurisdiction that you're interested in looking for properties and look for the lis pendens. That's the pending litigation, and that will give you all the information about properties that are available for short sales. Now, foreclosures are a little bit different than short sales. This occurs when an owner is in default and a notice of default has been filed in the court. So this person is truly in their property is being foreclosed on. Most states have a judiciary website that you can search for property in foreclosure, and on those websites it will show the names and addresses of the owner, the debtor, the addresses, the amount of debt that's owed on the mortgage, so you'll have information to do your research to determine if you're interested in any particular foreclosure property. Now, I have been asked about pre-foreclosures, and these this is when the owner is in default and they've received a breach letter from the lender that they are in breach of the contract, but they haven't actually, it hasn't gone to the judiciary. It has not been foreclosed on. The notice of default hasn't been filed in the courts yet. These might be harder to find at some real estate investing groups that I've spoken to. I do know of some people who find ways to find out about these properties. You might hear about them from other investors, but that is a possible opportunity as well if you have those contacts. Now, to locate foreclosure property that's actually been filed on, again, you can go to that state judiciary website. You can go to the courthouse in the area that you're interested in and look for those pending litigations of active foreclosures. You can also look in newspaper ads for auctions, and you can look for trustee sales. That's maybe how they are labeled. And you can also go directly to auctioneer websites. Now, I did some research a little while back on looking for some of these kinds of properties, and in the county that I lived in the time, I found 25 trustee sales when I went to look on a website, and there were 350 in the county that I lived in. Now, it was a metropolitan county, but you can find a lot of information by doing your research online to locate potential properties that you might want to invest in your retirement account. Now, there are some things to keep in mind. If you're looking at foreclosures, you are going to want to understand the foreclosure law in the state that you are looking at property in. That is state specific. So depending on the state that you are looking at foreclosure property and you want to become familiar with the law, you want to find out if there are any restrictions on purchasers. If you don't have expertise in this area, you may want to find a real estate attorney who is proficient in foreclosure law, as it can be very complex. You'll need to understand what that foreclosure process is. And one piece of information you definitely want to find out is, does the property owner, the person who's in foreclosure, have the right of redemption? Because that might affect your rights if you purchase the foreclosed property. So some things to consider as you're doing your research and talking to folks who have expertise in foreclosure areas. So I hope that's helpful to you. Now, REO properties are a little bit different. This is real estate that's owned by the bank. It has actually been foreclosed and the bank has reclaimed ownership of the property. You can contact local realtors who have properties listed as bank-owned for more details on all the information that you would need if your retirement account was interested in investing in that. You can also go directly to bank websites to locate their listings. And the bank websites that I have looked at will give you the agent contact information for their REO properties. So that's another way to find properties that you might be interested in. Now, this next topic is quite interesting. I actually know someone who did this recently in my former neighborhood, and this relates to 1031 exchange property. I did a joint webinar with Mr. James Brennan of Exchange Solutions Group, and you can find that information on our website if you'd like more detail hearing from him directly. I'll give you again kind of a bird's eye view of what a 1031 exchange might look like and how it might be useful to you in your retirement account investing. Now, this is the Internal Revenue Section 1031. That's why it's called a 1031 exchange. And what this portion of the code permits you to do is it allows an owner of property to sell that property and purchase like-kind property without incurring any immediate tax liability. So if you own an investment property and you want to sell it, there will be taxes involved. They could be federal capital gain tax, state capital gain tax, depreciation, recapture tax. So selling an investment property can involve some high tax liability. What you are permitted to do with a 1031 exchange is you can defer those taxes by doing this type of an exchange. Now, your retirement account earnings are already tax deferred. That's the whole point of having them in the retirement account. You are deferring the taxes on those investments until you begin taking distribution. So you might wonder how this could work together. Well, let me show you an example. You can co-own property with a 1031 exchange. So let me just show you, let's say you have property A. Let's say you own property A with your personal funds and your retirement funds. So this is permitted. I can talk a little bit more about this later, but normally you and your retirement account are disqualified persons. You can't do a direct transaction with each other, but you can, if you purchase at the inception of the transaction, the sales transaction, you can co-invest personal funds and retirement account funds. So that's what this diagram is showing you. You invested some of your personal money and some of your retirement funds in property A. Now you are ready to sell property A. What you could do with the personal proceeds, the proceeds from the personal portion that you owned of property A, you could do a 1031 exchange. Now, the portion that's owned by your retirement funds, the proceeds from that portion are going to go into your retirement fund and they are tax deferred. but the portion that comes to you personally will not be tax deferred unless you do a 1031 exchange. So let's talk a little bit about the guidelines for a 1031. First, you must use a qualified intermediary. And that is somebody who's an independent third party. They cannot have acted as your attorney, your accountant, your broker, or your employee within the last 2 years. So it is truly an independent third party. And this qualified intermediary is the person, company, entity that is going to hold the sale proceeds from this sale, and that will avoid your constructive receipt of those monies. So for a 1031 exchange, when that property is sold, you are not going to get your personal portion if you're doing a 1031. It has to go to the QI. So you must use a qualified intermediary for a 1031 exchange. Now, you also must invest in like-kind and eligible property. So there are some things that don't qualify. Property held, some things that do qualify. Property held for a trade or business or used for an investment by the taxpayer does qualify. So the individual that I know who did this 1031 exchange had the investment property, and then they sold it and reinvested in an investment property. So it was all for investment, and it was like kind. In fact, it was a rental townhouse for a rental townhouse. So they were very much like kind. So that's just an example of like kind and eligible. Some things that do not qualify, your personal residence. So you can't do a 1031 exchange selling your personal residence. Any developed lots that are held primarily for sale. Any property that's going to be resold immediately after completion of improvements. So not a quick rehab flip kind of thing. Any partnership interests and stocks don't qualify. Now, avoiding taxable boot. This is all of that idea that the money has to go to the QI. All of the relinquished property sale proceeds must be used in the purchase of the replacement property. So you'll have to keep in mind when you are selling the property, let's say it's $300,000 are going to be the proceeds to you. If you're doing a 1031 exchange, you have to use that full $300,000 in the new property. Can't be less than that. So you do have to use all of it in the purchase of the replacement property. You do have some time periods that you must follow. You have 45 days to identify possible properties, and then you have 180 days to actually do the exchange purchase on one of those identified properties. So these are set timelines, so you do need to keep those in mind. Some other things that you can learn more about on our webinar that was previously recorded, some methods of identifying property, and then how to set up the transaction. So please do go and listen to that with James Brennan of Exchange Solutions Group, and then you can get in touch with him directly if you're interested in something like that type of an investment. Tax liens are another very popular investment in self-directed accounts, particularly because they don't require you to have a large dollar amount in your account. So let's talk a little bit about what tax liens are. When you are purchasing a tax lien, you're purchasing the right to collect on a delinquent taxpayer's debt. So real estate property has tax liability. So if someone is not able to pay their real estate taxes, then the taxing authority can put a lien on that property and will put a lien on that property and will sell that lien to try to collect those monies, because that governing authority uses those monies to provide services. In the county that I lived in, our house had property tax. So this would be a case where the property owner is delinquent in paying the taxes. Now, this is not the same as a tax deed sale. That would be where you're actually purchasing the property. With a tax lien, you're purchasing the right to collect the taxpayer's debt. So you, in effect, are paying the taxes, and now you're going to collect those taxes from the original owner. Now, the nice thing about these is they can generate very high interest rates, and I'll tell you a little bit more about those in a moment. And they are senior liens. So that means if, let's say, this property owner is delinquent on their taxes, you purchase the tax lien, it is secured by the property, and then that owner goes into foreclosure. They can't pay their mortgage. So now you have the right to foreclose on that property. Your tax lien is a senior lien. And they are foreclosable, which I just mentioned. So how you can make money in the tax lien business is you'll earn that statutory interest rate. Now, the last time I checked, just a few that have very nice interest rates, the state of Maryland, the rate can range, I think it's by county, between 6 and 24% you can earn on a tax lien. Nebraska was 14%, Arizona was 16%, Florida was 18%, Connecticut was 18%. So that's a very high interest rate you don't really find on most investments. Generally, the terms of a tax lien are anywhere from 1 to 3 years. So if you're not getting the payment back from the debtor in that time period, whatever that jurisdiction has laid out, then you can foreclose on that lien and potentially take title to the property. So 2 ways you could possibly earn from a tax lien: earning that statutory interest and potentially taking title to the property. Now, I did a joint webinar with Paul Wojcicki. He is a real estate expert and educator, and he has done a lot of tax lien investing. That webinar is also on our website, so I'd invite you to listen to that for more details. He did talk about the variety of different ways in purchasing tax liens. There are different bidding processes depending on the jurisdiction. Some places use a lottery where each bidder has a number, and if your number is chosen, that you get to say if you would like to bid on that particular tax lien. Some jurisdictions use a round robin where you just go around the table and whoever is next in line has the choice of purchasing if they wish. You will want to become familiar with the statutory bidding requirements of the jurisdiction where you want to purchase tax liens. So you will need to do some research around these things. And you will want to contact the county treasurer's office for how that process works. Our client services department can work with you on how to make that type of investment, because of course each one might be a little bit different depending on where you're purchasing. So the actual purchasing process, again, different requirements and procedures for different jurisdictions, but they will likely require proof of funds. So for proof of funds, we can prepare a letter that is emailed to you as an attachment so that you can print it or forward it as needed. And our client services department would ask you to tell us the amount that you want listed on that letter, and then we'll verify that that amount is available in your account. And we ask for this information because we don't want to list a higher amount than you are bidding. You don't want whomever to know that you've got X dollars in your retirement account. Maybe that's not what you're interested in putting into this investment. So you will tell us the amount that you want on that proof of funds letter up to the value that's available in your account. For deposits, we can issue a deposit check that you just request that. You fill out a form and you give us a copy of the advertisement of the tax sale. And ACHs, if the payment does need to be deducted from an account, then we will set up a special account for your purchase, and we'll transfer the funds into that account. It's kind of a zero balance account, so you would tell us, okay, I'm going to bid up to $50,000. We would put $50,000 into that account that you could use for bidding. After you were finished, if you didn't use that full amount, the remainder would go back into your account. So it would be a zero balance account. So we can work with you to work out the details. You'll just need to know what your jurisdiction's requirements are and communicate that with our client services department. All of your purchases will need to be in the name of your IRA LLC. So you have to be very conscious of not using your personal name, but using your retirement account's name. Okay, so now moving on to precious metals. Boy, I am hearing a lot more about precious metals these days. Initially, only gold and silver U.S. American Eagle coins were allowed, but back in 1998, legislation was enacted that allowed gold, silver, platinum, and palladium bullion. It has to meet certain fineness standards. Keep in mind, no collectibles are allowed, so no collectible coins can be owned in your retirement account. We're talking about very well-defined precious metals. Now, investing in precious metal with SEC is very simple. We accept gold coin and bullion, silver coin, bullion, platinum coin and bullion. And we can tell you exactly which coins, if any of you are interested in that. I have a brochure I can share with you. But it is a very straightforward process. So what you would do is you would find the precious metals broker that you want to deal with and place your order with them. And you would receive an itemized invoice from them that you would fax or email to our client services department along with a request to transfer funds from your account. In other words, I want to purchase this. So we would pay that invoice on behalf of your retirement account. We would receive the precious metals on your behalf, and they would be stored in our bank in a safe deposit box. So you don't have to take, you won't be involved in the receipt of those. That will provide, having it in the bank will provide easy access for that physical delivery. We don't charge any storage fees. That's included in our management fee. So it's a very straightforward process. You really are just choosing the broker and what you want to purchase and then sending it to us, and we complete that process on your behalf. And again, your coins or metals are stored in a bank's safe deposit box. So there is the safety there. Again, let me know if you would like a brochure for more details on exactly what we can accept on your behalf, and we can take care of that for you. You can also invest in privately held businesses. I did a joint webinar with Jim Eshelman of Strategic Endeavors, and that is available on our website for you to listen to more details. And if you're interested, get in touch with Jim and talk with him about how he might be able to assist you if you were interested in that type of an investment in your retirement account. But let me give you some overview information from him. Your retirement can fund partial or whole ownership of the business. So if it's partial, you would be purchasing a pro rata share of the net income that would flow into your retirement account. Now, I do want to talk about ownership versus operation. You and your retirement account are disqualified persons. You're prohibited from doing a transaction between disqualified persons. So you cannot work in the operation of this business that is partially or wholly owned by your retirement account. That would violate the IRS rules. You can't take a salary from it. It must be an entirely passive investment. So you do need to keep that in mind. So when you're investing in a privately held business, and you might wonder, well, how do I evaluate business? I would recommend that you consider working with a business broker who has expertise in that area. They can help you find businesses for sale. They will often have listings that businesses have gone to them to find buyers for their businesses. There are also business listing websites that you could check out. And what you are going to be evaluating is the risk versus the reward. Now, small privately held companies can generate very high returns. So you will want to, of course, see records, and a business broker can help you evaluate those documents, and that would be an advantage to you. You are purchasing the future stream of cash flows that business is going to generate. So you may wonder what's included in the price if I am purchasing a business. Generally, it's going to be furniture, fixtures, equipment, a market rate lease if the business has that. You're going to be purchasing goodwill and intangibles. Now, if this is a company that has inventory, then that would be open to negotiation, and that would be something you would be negotiating with the seller. When you're investing in a privately held business, you can use leverage. In other words, seller financing. So if you find a business that you think would be a good investment for your retirement account, you can actually have the seller finance that to your retirement account. The one thing to keep in mind is that seller cannot be a disqualified person. So it can't be a family member who's an ascendant or a descendant, like a parent or a grandparent or a child or a grandchild. And it can't be a spouse. It can't be any company that you have a majority ownership of. So there are some restrictions on who you could actually be purchasing this business from, and who would be financing it to your retirement account. But you can do that if you don't violate those rules. Now, you will likely want to seek some competent counsel on the potential tax consequences, because there are tax consequences that can come into play. UBIT is unrelated business income tax, and holding a business investment in your retirement account can trigger that. When you sold that business, when your retirement account sells that business, that can also trigger UBIT. So you will want to talk with a tax accountant who's familiar with that and to evaluate that. Now, another way to invest in a privately held business is a little bit different, is by making a loan to the business owner. So you're not actually investing in the business, but your loan could have terms that the loan is paid back through streams of income or interest. It would be how you decided to set that up. Business owners often need funds for startup working capital or to fund inventory purchases. So you and the business owner would agree and set terms of the loan that your retirement account would be making. And that could be either a percentage interest on the monies loaned or a percentage of profits of the business. So again, that would be something that you would work out with the owner of the business. So again, I'd encourage you, if you're interested in that kind of an investment, please check out our website and the webinar with Jim Eshelman of Strategic Investment Endeavors. Okay, those are the investments I wanted to cover tonight. I do want to quickly go through a bit more information about STC and how we work with our clients. We use an LLC structure for each of our clients' accounts, and we do this because it gives a number of benefits to our clients. It gives you maximum flexibility in structuring complex transactions. So if you want to do something like this, business ownership, or you wanted to leverage a business purchase, having an LLC structure makes that simpler, gives you a lot of flexibility. It does provide additional asset protection because it is a limited liability company, but it is a very specialized one. Its operating agreement and organizational documents are written so that it can be owned by a retirement account. So it's a very specialized LLC that we set up for you. It does give you checkbook control over your retirement funds so that you have immediate response to investment opportunities. You can move very quickly when an investment comes along. Now you'll notice I have checkbook control in quotes, and that is because we don't give our clients the checkbook. We really do that for your protection in the event that you didn't know all the rules related to what you want to invest in. We wouldn't want you to accidentally invest in something that violated the rules, because the penalties for violation of the IRS rules can be very severe, up to forfeiture of your retirement account. So what we do is we look over your documents, your investing documents, before the transaction is funded to make sure that it's not going to violate any of those rules, the prohibited transaction rules. And then we can, same day or next business day, fund that transaction for you. This does also simplify asset titling. If you wanted to go to purchase a business or a piece of real estate, you can actually go to the closing on behalf of your retirement account and you can sign the documents. Unlike some other trustees or administrators where you have to send the closing documents to them for their review, approval, and signature. With STC, you can actually go to the closing. And using this structure does also make it easy to pool or partner with other funding sources, which could be other people, like I mentioned on that earlier 1031 information where there were co-owners of an investment. So here, let's just take a little look to help understand that. This is a schematic of our retirement plan LLC structure. You see on the upper left, your current custodian. You decide that you want to work with us and complete some documents. One of those will direct your current custodian to transfer or roll over monies from your current account to our self-directed custodian. While that's happening, our operations department will be setting up the LLC in the state of your choice that's going to be owned by your retirement account. And then once the money has reached our custodian and your LLC is set up, then the money will move to a bank account that your LLC, your retirement account, now has access to, and you're ready to begin investing. So now your retirement account LLC goes out, and in this case, you've invested. Investment number one is a tax lien. Investment number two, you've purchased some gold bullion. That's in the safe deposit box in our bank. And investment number three is a foreclosed real estate property. And you'll notice this property has 4 investors: your father, your daughter, some of your personal money, and some of your retirement money. Normally, those 4 parties are disqualified persons to each other. However, as long as you invest at the inception of the purchase transaction, your co-investors at that inception of the transaction, this is an allowable transaction. So you could co-own this foreclosed property. So if you need more information about how we can help you structure complex transactions, co-owned investments, we would be happy to help you understand how that works. A little bit about STC. We are a full service administrator. What we offer is that retirement account LLC structure setup, that protected checkbook control I described for you. We have CPAs and attorneys available to answer any technical questions you have. Our client operations department and client services department can offer you guidance on transaction compliance. You are welcome to call them as much as necessary to make sure you understand how to structure a transaction properly, how you want the document titled, all of those kinds of things they are happy to help you with. We'll handle all of the back office support, which means all of the financial statements that need to be maintained for all of the transactions you engage in. We'll maintain financial statements that show your funds, show your expenses, your income. You'll have access to that online so you can see actually how much cash is in your account. We'll supervise the regulatory reporting that's required, and we will oversee the annual valuation. So we'll really do all of the administrative support and guidance, compliance guidance functions, so that you can focus your attention and your energies on finding the best investments for your retirement account. We'll handle all of the other stuff that needs to happen. So how can we serve you? You may know that you're interested in opening a self-directed account. Please do get in touch with us. We can help you get started right away. You may have clients or colleagues who would be interested in knowing more about self-direction. Again, we're happy to talk with them through you, however you'd like to connect us, or you may simply need more information yourself. So here's our website, stcira.com. Our corporate office number is on your screen, and my direct email address. So as questions come to mind, if that happens after we finish tonight, then please do get in touch with us. We'd be happy to give you whatever information you might need to help you evaluate if working with us with a self-directed account is what you'd like to do. Now I am going to open the floor for questions. I received some in advance, so let me just do a quick look at these papers to see what those questions were. Okay, what is the time frame to get my account set up and running with STC? Typically, for the full complete setup, it takes 4 to 6 weeks from the time that we receive the original paperwork. And during that time frame, we're going to be coordinating the transfer of your assets from your current custodian to our new custodian, your new custodian. We're going to be working to create that LLC that I mentioned. And during the, so not all of these things are directly in our control. Your custodian's time frame for moving the funds and the state's time frame for getting the LLC set up are their time frames. So we will be diligent about working on it, but we can't control the speed that they do those things. What we will do is during that setup process, we will keep you informed of the status via progress email. And then once your new account is funded and the setup is complete, you'll get a confirmation email from our operations department, and you'll also receive a binder that will have copies of all of your documents and instructions for making future contributions and for purchasing investments. So once your setup is complete, that does take some time, but once that setup is complete, then you have that same day or next day investing. So we can do a quick turnaround on your investments. Once my account setup is complete, what does STC need from me to purchase an investment, and what is the turnaround time? Okay, so we simply need one of our forms. It's called a request to transfer funds. It's really saying I want to purchase an investment. That will indicate the type of investment, the dollar amount, and then any appropriate backup. So if it was a real estate transaction, we might need a HUD-1. If it's a promissory note, we'll need the note documents. And as long as all the paperwork is in order when we receive that, we can same day fund that if we have the documents by 2 p.m. Eastern time. That's the cutoff time for our bank. We are located in the Eastern time zone. So we can generally generate a same-day wire transfer to the seller and purchase that investment for your account. If we don't make that 2 p.m. deadline, then it would be next business day. Okay, I sort of answered this, but I'll answer it again. Can I use my IRA funds to make an investment with my spouse? Typically, the answer is no. Your IRA is prohibited from engaging in transactions with your spouse or your spouse's IRA. However, if you do that co-investing at the inception of the purchase transaction, If the investment is structured properly, correctly, you can invest with prohibited parties at the inception of the transaction. So what we encourage our clients to do is to call and discuss any complex transactions such as this in the early stages, and then we can provide you with the information you need to make sure you're not heading down the road toward a prohibited transaction, because we want to help you avoid doing that. Okay, it looks like I have time for a couple more questions. If you have a rental property in your account, who does the renter send their rent check to? That's a very good question. That really depends on if you are using a property manager or not. Typically, when the property manager collects the rent, the checks are made payable to them, the rental checks, and then they forward your IRA LLC the excess funds. So if you're not using a property manager, then the checks would be made payable to your IRA LLC, not to you personally, and mailed to our office. They could mail their check to you, but then you'd have to turn around and mail it to us. So in either scenario, you'll get an email from us when we have received the funds and posted them to your account. Okay. If I want to put IRA money into a self-managed stock brokerage account, can I? Can I actively trade in that account with IRA funds? Yes, you can. We do have clients who have funds that they're looking for their next investment, so they might have monies in their account waiting for them to locate that next investment, and they want to keep them invested short term so they're earning. So yes, you can open a brokerage account with any company that you choose. The account should be opened as a business account in the name of your IRA LLC. We do ask, our corporate office asks that you send us copies of your monthly statements. We need to make sure that you haven't made any deposits or withdrawals from that account directly, because remember, it's your retirement account that owns it. So deposits and withdrawals need to go through your retirement account. So we would want to see those. But absolutely, you can have a brokerage type account in your self-directed retirement account with STC. All right, I have run out of time for tonight. So I do thank you so much for joining me. I hope that you will get in touch with us if you have any questions that I didn't answer, or you're interested in getting started and having a look at paperwork. Please do visit our website at stcira.com and listen to some of those previously recorded webinars if you want some more detailed information on those particular types of investments. Thank you so much. I hope you will join us for our next educational webinar. Good evening.